All right, today we're going to dive into a really core principle of company law. It's a doctrine of capital maintenance. Now, I know it sounds a bit technical, but trust me, it's like this invisible shield that makes so much of modern business even possible. So let's kick things off with a huge question. I mean, if you own a company, what actually stops you and the other owners from just taking all the money out and leaving behind an empty shell? It's a serious question, and it has a very, very important answer. To really get why this matters, just picture this. A supplier gives a company £50,000 worth of goods on credit, right? They're trusting they'll get paid. But then, the very next day, the owners decide to pay themselves a dividend for that exact same amount, completely draining the company's bank account. And just like that, the supplier is left high and dry with nothing. This is the exact kind of disaster the law is built to prevent. So to stop that nightmare empty promise scenario from happening, the law steps in with something we can think of as the capital shield. It's basically a legal framework designed to create a buffer, a layer of protection for anyone who does business with that company. And this shield, this whole idea, has a name: the doctrine of capital maintenance. What it means is that the money shareholders first invested to get the company off the ground, its share capital, isn't just a pot of cash they can dip into whenever they want. No way. The law treats it as a permanent fund, a safety net that is specifically there to protect creditors, just like our poor supplier in the last example. Okay, to make this super clear, let's use a really simple analogy. Seriously, forget all the complicated accounting stuff for a minute and just imagine a company's money is kept in two totally separate jars. So you've got your first jar. Let's call it the capital jar. This holds the original cash that shareholders put in. This is the company's foundation, and the law basically keeps this jar locked. It's bolted shut to make sure there's always that safety net for creditors. Then you have the second jar, the profits jar. This one gets filled up with the money the company actually earns from, doing business. This jar is unlocked because this is the money that can be used to reward shareholders for taking the risk. And that separation, right there, is the heart of the whole doctrine. Okay, so if the capital jar is locked up tight, how on earth does a company legally reward its owners? Well, there are some really strict rules for dipping into that unlocked profits jar, and it all has to follow a formal, legally defined process. And here is the absolute key. Dividends can only be paid out of what are legally called distributable profits. That's the technical term for the money in our profits jar. And this isn't just about the profit from last week. It's the total profit the company has actually realized, meaning it's cash in the bank, not just on paper, over its entire life, minus all of its realized losses. This is so important because it stops companies from paying out dividends based on optimistic forecasts that might never actually happen. The way you figure this out is, believe it or not, pretty straightforward in theory. You just take all the realized profits the company has ever made, and you subtract all the realized losses it's ever had. Whatever is left over, that's it. That's the absolute maximum amount that is legally available to be paid out to shareholders. But even if the money's there, you can't just write a check. There's a formal procedure to follow. First, the company has to do the math and prove it actually has distributable profits. Then, the directors have to formally propose the dividend. And finally, the shareholders have to vote to approve it. It's a very deliberate and accountable process. And believe me, directors can face some serious legal trouble if they get it wrong. So we've gone through the what and the how. But now for the really big question, why? Why is this doctrine so incredibly important? Well, it's way more than just a legal rule. It's pretty much the foundation of all business trust. Think about it. This whole doctrine is the reason banks are willing to lend money to companies and suppliers are willing to give them credit in the first place. It protects them from that nightmare scenario we talked about. It also stops insiders from just stripping a company of its assets for their own gain. And when you put all that together, it creates the stability and confidence that our entire economy needs to function. When you boil it all down, this isn't just some dusty rule in an accounting textbook. It's the absolute bedrock of creditor confidence. It's the fundamental promise that a limited liability company makes to the world, saying, hey, there is a real fund of capital backing up everything we do. So I want to leave you with one final thought to chew on. This whole concept was really born in an industrial age, an era of factories, machines, physical stuff. But today, the most valuable assets a company has are often intangible, things like software, data, brand reputation. So the big question is a capital shield that was designed for a different economic era still strong enough to protect everyone in our modern digital economy? That's a huge question for the future of business. Thanks for joining me.